Hello, Smart Money Tube podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm talking with Bruce Bond. How you doing, today, Bruce?
I'm doing great, Kurt. Thanks for having me.
Good. Well, we brought Bruce on because I found some interesting stuff a few years ago that Bruce was doing, and really wanted to bring him on to talk about it. So Bruce, tell us a little bit about your background.
Well, I started in the business back in 1986. I was selling bonds for a high net worth group out of Chicago and did that for quite a while. And then moved from kind of the advisory side of the business over to the product side of the business, where I was a wholesaler for a while for a firm. And then, started my own business in time. I was with Nuveen. I don't know if many of you are with Nuveen, during the 2000s, and really cut my teeth in the UIT business. And but then just got very interested in exchange traded funds back in the early 2000s, and decided I wanted to start an ETF company. I had done most of the work. I was head of marketing. I had transitioned over to a position at Nuveen in marketing, was head of marketing for them, and had come up with the name PowerShares, and had worked on the exemptive relief and what type of products we would be interested in bringing and all these types of things. And Nuveen at the same time decided that they were not going to get into the ETF business. And so I was like, well, I think this is a great opportunity and a great product category to be involved with. And so I purchased from them the kind of the work product that I had been doing for them, and they sold it to me, and I left and started PowerShares, and then sold PowerShares to Invesco. Many of you are familiar with that. And then after that, I was out of the business for a little bit. I had a non-compete, and then came back into the business in 2018, basically late 17, 18, and started today what's called Innovator Capital Management.
Nice. Yeah, that's great. So you've been a lot of places. Tell me a bit about UITs. It was funny when I started in this business in '99. It wasn't really a big thing, but it was definitely part of things we had to learn.
Yeah.
But very few people did it. But there was these like carve out niche products. So what are UITs all about? Because I don't think people even get in those anymore.
Very good. Yeah. I mean, I think that's exactly, Kurt, where they got a lot of success was packaging in these thematic ideas within the equity market. Originally, when UITs were brought to market, it was done by Van Kampen and Merrill Lynch and Morgan Stanley and these types. And it was all in bonds, mostly municipal bonds. And you could buy a set of municipal bonds rather than buying one bond that would have, close or similar maturities in them. And that's how they started. And then from there, they really morphed into kind of like a portfolio of equity holdings. And they really got traction with the dogs of the Dow, if you remember the dogs of the Dow. And these were basically 13-month portfolios. They can't be changed once they're set up. And then they just roll every 13 months, and they buy the 10 highest yielding stocks in the Dow Jones, or the 5 lowest price of the 10 highest yielding. And they just continue to do that and roll year after year. And so that's when UITs really started to take off, kind of got their second life, was in the equity space. And a lot of, they also had 5 and 6 year products that owned like bandwidth and internet and B2B and all these other thematic or little industry groups within the equity market. And they just really exploded from there. And the firm that I was with was really leading that whole charge. When Nuveen hired myself and a couple other guys to come work for them to get them back. Nuveen was the biggest in the fixed income UIT area, and they had fallen way behind. And so they basically took the motor out of this other company and brought it over, put it in their chassis, and said, okay, we want to be in this equity business. Can you help us figure out how to do this? And we went over to do that. And really, at the end of the day, headed up what they called structured products, which included like closed-end funds, UITs, and ETFs at the time at Nuveen.
So yeah, I'm curious because I remember all that with Nuveen. Like we got plastered with like marketing from Nuveen of all these I remember all like the different sector
Yeah,
portfolios, and it was
yeah,
like, oh, you can buy this, you can buy this. It was all really cool. It was the first time I ever kind of saw stuff like that. But
yeah.
I'm curious. So why did they fall out of favor? Because I don't hear about them anymore.
Well, I think and by the way, that was probably me doing all that marketing to you because that's what I did for them. But really, if you think about the internet, for example, the great thing about those products, and they have a lot of negatives too. First of all, they were loaded products, and I think that was one thing that was kind of going out of style, and going more to fee-based type products. So that was during the transition that was happening. And then secondly, when you put together like a bandwidth, for example, is one of the ones that we had, you have a group of stocks, but they can't really change, so a lot of those companies went out of business. Some of the companies did well. And then in 6 years or however length of a product you bought, they would turn over. And people are like, is that really the smartest way to participate in this segment? About that same time is when some of the very first ETFs were being launched. In fact, that's when the sector spiders got launched, and people were like, "Oh, I can buy the internet, a portion of the S&P 500, the internet portion, in a little segment here." Now it's more like 100 stocks rather than 30 stocks, but it's a little more broad base. I can get exposure that way. Then I don't have to worry about, oh, okay, are the names changing? Am I getting the smaller cap ones running up in here and kind of, so there was a lot of that. And I think a couple of the big things were the loaded nature of them, the fact that they didn't change. And from a taxable standpoint, you had to turn them over every once in a while. Now, they were long-term gains, but in an ETF, as most of your listeners probably understand, there's typically no cap gain tax paid, and therefore you can hold them long-term. Your money, multiplies or compounds at a greater rate, and which is very important for long-term investors. And so I think really ETFs ate up a lot of that business. In fact, at PowerShares, I left to start PowerShares, and we were the first company to bring out a thematic ETF, and it was clean energy. It was the first thematic ETF in the industry, and it was launched by PowerShares after I started that. And my knowledge of the UIT business is what informed really this new ETF business when I got started in exchange traded funds.
Nice. So I wonder, because the UITs stopped, which I understand the ETFs, that actually makes a lot of sense. But then the industry pivoted and they do structured products now, which is very similar, right? In terms of
Mm-hmm.
construct, it's a fixed time period. It's some weird thing that they create. They do whatever they want. Like, so UITs went away, but structured products are around. So tell me a little bit about that.
Yeah, well, I think the important thing is there still are UITs out there, and there's less companies, and who does the business is more narrow. There's only a few groups, and so, but is still business out there that's done in the UIT structure, just not very much. In fact, an important note, or kind of an aside, the first ETFs that were launched in the industry were actually in the UIT structure, not in the mutual fund structure, and so there are some still out there, that being the Qs, the Spider, and those ETFs. But so anyway, we looked at structured products similar to UITs and said, this is a older product structure, and it has even more issues than UITs have. I mean, first of all, you have credit risk because it's issued by a bank. A UIT doesn't have that. You own the underlying. In fact, in a UIT, you can take an in-kind distribution and actually have the underlying issued to you. But yeah, so that was one of the problems with these no-C structure products. Secondly, was that, they're opaque. You can't really see what you own or what's in there, what the pricing of them is on a real-time basis. So, they're not liquid. You can't sell them when you want to. I mean, can you get a bid? You can potentially get a bid, but it's a very thin market, and you usually take a big hit when you do that kind of thing with structured products. And so there's all these issues, and again with structured products, they're a loaded product. Typically, they're expensive to own, and therefore there's all these and the taxable nature of them as well. You got to pay tax every time that thing sells, so or turns over, ends, and they get hard to track. You got 1,000 QSIPs tracking these things, and so there's a lot of struggles with the those particular products for investors and for advisors alike. And at Innovator, we looked at that and said, we at Innovator and at PowerShares, we're just big believers in the ETF structure, investment structure. We just think it's so much more efficient for investors. So if you can buy anything in an ETF versus something in a mutual fund or some other structure, it's probably going to return more of the investment return to you than any of the other structures. And that's why we like it so much. And so we said, what other structures out there are just really messy and not good for investors and don't provide a real efficient return? And we thought structured products was one of the biggest ones. That, along with, annuities, have a lot of friction potentially in some annuities too. So some of the things that we're doing at Innovator also, have likeness to fixed index annuities and some of these things. And so we're starting to look at those categories and say, okay, is there a better way to do this? And can we use an ETF to deliver better performance to investors utilizing the ETF structure rather than these older structures?
Yeah, it's interesting. I mean, you mentioned a lot of different things because I know structured products. I get interviewed probably weekly about the structured products weekly, and just really dissecting these all. And I mean, there's a lot of garbage out there. And
Yeah,
it occasionally get a good one, but if I had to theorize, it's, hey, these big institutions have a position they have to liquidate and they can't. So let's just package it up and call it a structured product and dump it onto the retail public. That's how it feels.
Yeah, basically. I mean, they use their balance sheet to issue these notes, and therefore, that's how they issue debt. And so it's a huge debt issuance for them, and it allows them to make money off of it. And, for people that purchase the products, there is built-in fees inside the product that you can't see when the product's structured. And so you don't really know, the cap is affected by the amount of fees within the product. And so you just look at it and figure, okay, here's the cap, or, here's the return profile. It's very difficult for most people to understand fully what's baked into that overall product. That's what we love about the ETF, is that it's a very transparent process. You see exactly what you own. You own the underlying. You can sell it anytime. All those other wonderful benefits people are used to with exchange traded funds.
Yeah, and you mentioned a point about the fees of structured products and the opaqueness. It's interesting because I can always look at a structured product and say, all right, how would I recreate this on my own? Because there's nothing they're doing that's fancy. It's usually like, oh, well, it's basically like a covered call that's packaged up, or some sort of spread, or
Yeah, put
whatever.
spread, or yeah,
It's usually something like that. It usually involves options to some degree or another.
yeah,
And
yeah,
so I always find it interesting that they do that. I've even had a provider, right? I talked to one of the wholesalers and they're like, yeah, just tell me what you want. We'll create a product for you. I'm like, really? They're like, yeah, I'll just
yeah,
create one. I'm like, I could do that myself. Like, I need you to do
yeah,
that
yeah,
for me.
exactly, exactly.
So it's interesting. Go ahead.
I can see sometimes. I mean, there are, they'll create the custom notes for you. Like if you do have a very large, investor that needs to invest some money, has a very particular outcome that they need or time period that they're trying to address or things like that. I can see that there might be times that a custom product would be of some value to somebody. Most people, as you know, Kurt, they're just not that familiar with options, and structuring, putting together a structure that's going to deliver a very particular outcome can be difficult for a lot of people. And The other thing that I would mention that in the ETFs that Innovator issues, it's very difficult for an individual investor to do it at the same price level that we do it at, just because it's done, at the institutional level, and has a very precise, return profile, and it's all a zero cost package. So it's difficult for investors to do that if they try to recreate some of them. Now, in the note, you don't really know what you're paying, but in the ETF, you can see exactly what you're paying and the exact cost. So you can say, okay, can I do that for myself for that kind of money? And it'd be very easy for you to determine whether or not you think you can. I've had a lot of advisors with the ETF say, yeah, I can't touch these types of costs if I try to do it by myself.
Yeah, what's interesting is when I first started looking at your stuff, it must have been like, I don't know, 5, 6 years ago. It was right when you guys had a handful of, you have a lot more now, but you had only a
Yeah.
handful. And it was interesting because you could actually track the return of certain periods and certain quarters for what they were doing. Um,
Hmm.
so tell me a little about, because I'm guessing, but all of these look like option strategies that you've packaged up into an ETF, or most of them anyway. I don't know about all of them, but a lot of
Yeah,
them.
pretty much all of them. Yeah, I
Okay.
mean the vast majority.
So how does that work with options within an ETF? Like, how is that easy to manage, or how does this work? Because, options are trading all the time, and I would imagine it gets a little tricky to manage on your end, but how does this work for the investors?
Yeah, actually, it's very straightforward. I've had to introduce a lot of very complicated ETFs in the past, but if we just look at a simple buffer strategy, where you have, let's say, 15% downside buffer. So you can't lose money for the first 15%. After that, you would start losing. And then you get, let's say, 15% of the upside of the market, and then you're capped out. Okay. So that's probably one of the more popular types of strategies that people use. If you use something like that, it's actually only like 6 different positions within the ETF. And the interesting thing, they're all what are called flex options, which are a newer option that was introduced by the SIBO probably 10 years ago or so, but they really haven't gotten used until recently. They're very active, becoming very active now. And what is unique about a flex option is you can have a particular start date and a particular end date. You don't have to go, how typically you think of options of, oh, they have triple witching and they have all these different schedules that you have to meet the listed option schedule and just buy at what's on the exchange. Well, with these particular ones, you can have really what's considered a custom option with a specific start and end date. And with whatever the number of options are in the portfolio, when we set it on day one, let's say it's 5 options, you buy those same exact 5 flex options for the entire period of that ETF. And so most of these, like the 15 buffer I was talking about, are 1 year. So you buy it day one and you hold it till the end, and it gives you a 15 downside protection of 15%, and then it gives you 15% potential participation on the upside. On the upside can vary. It can be 14% sometimes, 16% sometimes, 20% sometimes. So that's how it varies. But it's very easy because you're just buying these same 5 to 7 positions over the year as money flows in. And then at the end of the year, what happens is there's just a reset. So you don't get out of the ETF, you just stay in there, and it resets, and it gives you a new 15% buffer on the downside, and it gives you a new cap, whatever the cap the market has available at that time, and then you just go for another year. And so you just hold it through time, having this level of a 15% protection on the downside, but getting 15% on the upside. And that is a super, we have a 9%, a 30%, we have all these different flavors, that you can choose from depending on your risk profile. But that is super attractive to a lot of individuals today. One of the things in our lives that is a struggle for most people, especially investing their money, is that, it's not predictable at all what you're going to get at the end of the year. You have no idea what you're going to get.
So let me ask you this,
Yeah.
because it brings in some questions into mind. is it's great that people can hold on to it forever, but people don't, right? They buy something and then they have to sell it later. I would imagine the flex options are not as liquid. They might be great if you have a UIT and you're buying and holding for a year, but if you're buying and selling it, it's probably not as liquid as a listed option. So how do you handle that without
No,
getting creamed?
it's like the spread's like 2 cents wide.
Oh,
They're
okay.
ultra liquid. They're ultra liquid.
Okay.
And remember that the flex options are based on S&P, index options and SPY options. And
Right.
so it's the deepest, most liquid market in the world. And so, yeah, they're ultra liquid. I mean, we've had a couple $1 million, purchase and gets done, within a penny of the
Okay.
NAV. So
Well,
it's not a big deal at all.
I just say that because Vanguard has options and the spreads are ultra wide. So, and that's also on a liquid ETF, but the options are not great to invest
Yeah.
in.
Well, I think anything you try to buy during, a spike up or down or right at the, investors need to know that they need to let everything get trading before they try to put those, any kind of I mean, I would never put a market order in, unless it's an ultra liquid ETF. I would use limit orders, but
So, so it brings up the other question too. So, this is something I'd love to understand better. So let's say you buy the option today and the S&P is at $100, for example, and you got a 15 up, 15 down, what you're talking about. So it means you
mhm.
can make at the end of the year, you can make 15% upside, 15% downside. So how is it typically priced in the market? Is it priced for liquidation or is it priced for whatever people want to pay? Because realistically, the market drops 50% and then, it's not going to cap it at 15%, most likely. I mean, the market
Yeah,
won't.
it does. Well, the market may not, but remember ETFs. The beauty of ETFs is that they mirror the NAV of the underlying, pretty much right on top of it. So this is a basket of options. So this basket of options trades throughout the year. So if the market goes down, initially in the year, options have a lot of time value in them. And so you may see them trade down a little bit with the market. That's why it's important to note for people that use those types of products is that you need to hold them to the end to get the outcome. They're going to trade around a little bit in the middle. And what I would like to say is they don't mirror like the spider or something like that, SPY, but they reflect the movements in it. So if the SPY's down, it might be down a little bit. If the SPY's up, it's probably going to be up a little bit, but it's going to remain close within, first of all, it's not going to trade down very readily because it knows that it has a 15% buffer. And so, if the market's down 5%, it's probably going to barely be down at all. Even if the market trades down 15%, it's going to move down some, but it's not going to trade down very much. But then as the market goes up to 10%, it's going to move up with the market, maybe 5%. And even if the market's up 15%, it might go up 10%, but it's not going to go all the way up to 15% until the very end of the outcome period. And then it's going to price exactly where we said it would. And I think that's the real power behind these products. What other products can you buy in the marketplace and talk to a client about, look, the market's up 15, we're going to get 15. The market's down 15, we're not going to lose anything. The market's down 16, we might lose 1%. To be able to shape returns like that and provide those types of predictive outcomes is super powerful for especially investors that, I think I read recently that 75% of assets are investors 55-year-olds and greater and older. So people that are in that age bracket, they don't want to have to make their money again, re-earn it. And so they're very open to these types of ideas, knowing that they have protection built in to the product. But they get the upside and they know what they're going to get. They don't have to guess of what the outcome will be.
All right. Well, Bruce, I really appreciate you coming on the show and sharing your wisdom with us. Where any final thoughts and tell us a little bit about where people can find more about you.
Okay, great. Kirk, thank you again for having me. It's been great. Yes, they can go, if they have interest, they can go to innovatoretfs.com, innovatoretfs.com. And there's a tremendous amount of information on our website in the tools and literature section if they want to understand more how these buffer ETFs and the other types of ETFs that we have available to them. And I would just leave you with the concept of, I mean, we tend to try to protect all of our greatest investments, our house, our cars, and we buy fire insurance for our house to make sure that if it burns down, we can pay for it. And I think it's very important for people to start to think a little bit more like of their portfolios that way. And it's difficult to do because there weren't a lot of really good tools out in the marketplace for them in the past. It did take an options, a lot of knowledge in options, but options are very expensive. They cause you to give up a lot of return too. I think the beauty of these products for most investors is they can look at them and they can say, yeah, I get this amount of the upside, I get this much protection on the downside. For me, that's a good trade-off. I'm for that trade-off. And so I think if you are interested in looking at those types of opportunities in an ETF that is the most efficient, the most transparent, the most liquid, I mean, you can sell them any day you want to sell them. And you're never held up in these types of products. And so if you need your money, you can always get it easily, and you can buy them actually at any time. We encourage people to participate around the beginning of the month in the product that they're interested in. But these are great products for people to invest. We just launched a product I want to mention called AJAN, AJAN. What AJAN does is it's a 2-year product, which is the longest product that we have, but it gives you 100% protection on the downside. You can't even lose money on the downside, and you get basically 15%, roughly 15% on the upside over the 2-year period. So people that are just sitting in cash and they're just, they're traumatized by this market. They're just wondering what's going to happen next. This is a great way for them to get cash off of the sideline, get it invested in something that they're not going to lose their money in, but they're going to get exposure to the upside of the equity market. And there are not products like this out there available for most people. And I think this is a tool, is a great way for you to get back involved, get your money growing. No, you don't get 100% of the upside because, and this isn't too good to be true. So people need to know that, yes, we are giving up some of the upside in order to finance the cost of this product so that you have 100% protection on the downside. And so you can only get that 15% return, but you're going to get some return. And I think that's what people should be thinking about long term. And again, this just resets and goes again over another 2 years after that period. And it just continues to do that throughout its life. And you can continue on with that. So I really appreciate you giving me an opportunity to explain these exciting developments in the ETF space. And you have any questions as well, feel free to give us a call at Innovator Capital Management anytime.
Great. Well, Bruce, I really appreciate you coming to the show and your sharing your wisdom with us. We'll definitely have you back on in the future. So thanks again.
Love to do it. Thank you again, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Bruce. Really appreciate him coming on the show. Now we're into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. How are you today?
Good, good. Glad to have you here. And we also have our very own Tim Baker. Hey, Tim.
Hey, Kirk. Thanks for having me.
Great. Well, Phil, why don't we just dive right in? What were some of your takeaways from the interview?
So these products, I will say I don't use them. I think that they can have a use for those that are risk averse because they can cap your losses on the downside. My big concern is, number one, the cost that comes with them. And number two, if I think about the market itself over the long term, averages in that 8 to 10% range, that includes the losses. So if you're not that risk averse, you're going to do better if you just had your market exposure and didn't have these type of products that could limit you.
Yeah, no, that's great. Appreciate that, Phil. Tim, what about you? I mean, what are your opinions on this type of thing? I mean, I know you like ETFs, but these are ETFs with a little bit of a flair to them. So what do you think about ETFs that are just not indexing, but other, I don't know if it's even active management. It's just more of a thematic kind of approach.
Yeah, I think thematic is probably a better way to think about it. Some of these things are just consistent covered call options, or consistently buying puts when or collars or whatever it might be. I mean, there's option strategies inside of those. And I would echo what Phil said. Actually, the way Phil just put that, it just makes me think of a fixed index annuity, something that's really expensive and caps your long-term returns. So I understand where these firms are coming from. They're smart. They recognize that there's an audience for these things. There are some people out there that will say, I'll sacrifice my upside return to avoid downside exposure. I don't want the volatility. From my perspective, you could probably cobble that together, not quite as protectively, but in some way, shape, or form with a combination of stocks, bonds, and cash, and do it significantly cheaper. But yeah, that's always been my argument. Whatever you're giving up on the upside, somebody else is keeping.
Yeah. Yeah. I mean, I think it's interesting because, looking at these, I mean, basically these ETFs are just, they're just option strategies. And anytime you introduce risk management, there's always an exchange, right? It might be an exchange of upside for protection. It might be an exchange of volatility, right? For more defined outcome in exchange for volatility, right? There's always, if you think of all the different option strategies out there, and there's a ton, you can create an option strategy for any outcome you want. You come up with some weird potential outcome. There's a strategy for that. And I think the question is does it align with your thinking, right? And I know there are a lot of structured products out there, and the broker dealers love to sell these because there's big fat commissions attached to them. So brokers don't hate me, but it's true. I haven't seen too many of those structured products that are actually any good. I get interviewed about once every other week by the newsletter for that part of the industry, and I rarely have one that I say, wow, this is great. Maybe 1 in 50. Like most of them are garbage. And it's not that they're poorly constructed. It's not because they're trying to take money from people. It's just the nature of Wall Street. Like they're not going to give you their best stuff, right? It's usually someone on the other side is trying to get out of a position. They're packaging up and they're selling to retail people. So if the retail people are getting it, it's probably because it's not all that good. The best stuff goes to the institutions, or they keep themselves, right? So just keep that in mind. But these are structured similarly, And these are not done with the same bias in place as a structured product. These are just continuous strategies that you can apply. If you wanted something that's more of a spread where your upside's 7 and your downside's 3, they could create a strategy for that, right? If you want something that's no cap in the upside, but your downside's like 7%, loss, there's a strategy for that. Like if you really kind of look through the construct of these, they're I don't know, they have a ton of these now, but there's a construct for just about anything you want. If you had an outcome, structured products will do that too, right? You can also create some. If you're big enough, you can create some. But the point is these are strategies that are not plain vanilla. And if you're looking for plain vanilla, this probably isn't the right thing. But if you've got some, hair across your butt that you just think that the market's expensive or it's overvalued, or you think we're set up for a crash, or you're just concerned about risk in general, then maybe a plain vanilla might not make sense for you. Maybe you might want to explore some of these. So there's something for everybody, and there's a tool for every situation. The question is, are you using the right tool for the right situation? And I think that's a more important question to ask yourself than, is this good or bad? The real question is, that's like saying, is a hammer good or bad? Well, no, a hammer's not bad if you're trying to put a nail into a piece of wood, but if you're trying to saw it in half, yeah, it's not a great thing. And I think you have to look at it this the same way as, is this make sense for you? I don't know. Depends what you're trying to accomplish. So Phil, when you're, I know you have a storied background with a lot of different things, but I know you mentioned when you heard me talking about UITs, you thought it was IULs. Kind of, how do you've seen a lot over the years, like how do you kind of perceive these kind of niche kind of strategies? Is this something for everybody, or how should people be looking at these?
Well, I think you just used the right word. They're niche strategies. There's certain people that they're going to work for, but to me, for the vast majority, you don't need them, because you look, as Tim said, I can go and I can put together bonds and cash and stocks, and I can protect you and I can do things to diversify you so that it should have the same effect, but in a cheaper way. And then you get to keep that upside. Yeah, sometimes we have downside, but remember, if we're investing, I think of it as a long-term equation. And if I'm going to invest, it means that I think the market's going up long term. Otherwise, there'd be no reason to ever invest. And as long as I'm taking that approach, unless I'm in retirement, right, and facing the fact that what we call sequence of return risk, right, that what's the worst time for the market to go down? It's that year that you retire, right? Because I can't add any more money. But if you're adding money to the market, a falling market, we don't want to think that way. Our brains aren't usually wired that way. But that's really opportunity, because I can buy the same thing at a cheaper price. And then if I did that, when it got back to even, not only did I got back to even on the stuff that I already owned, but I made money on the stuff that I bought at a discount. Now, that can't always happen with a stock, right? So that's why we talk about using ETFs, something like that, because now I've got that diversification. I'm looking at it from a market perspective and just an individual stock perspective, because I've seen studies from JP Morgan talking about there's lots of individual stocks that they hit a number and they never go back to it. Like if you look at, this isn't a recommendation for or against, but right, if you look at Cisco in 2000, right, during the internet bubble, that stock peaked. It's never hit that level since, ever. So that's the danger that comes with individual stocks. They can get a number. Some stocks keep going up, right? And over the long term, they continue to go up. But a lot of stocks, they hit a peak at some point and then they never get back to that number again. So if you get worried about those type of things, you want to broadly diversify in the market, you're going to use products like this that can help cap your downside so you don't have to deal with that threat that comes with a falling market.
Yeah, no, I totally agree. I think it's good insight. Tim, what about you? I mean, you're heavily involved in ETFs. What do you think of these niche products versus just like a plain vanilla for most people?
Well, just to comment on Phil's thing, we recently brought in a client who insisted on putting sell stop orders on a bunch of his stock positions. And I kept telling him, like, these are basically market timing tools. You should decide which stocks you want to own. We'll keep them. The rest we'll sell and we'll put into our ETF strategy. Insisted on sell stop orders. Then he wanted me to change them to trailing sell stop orders, which for your listeners that don't know, a trailing sell stop order, instead of just putting in a price to sell the stock, you put in a percentage below the current price. at which it will get executed. And so he had these sell stop orders in like 15% below their current stock prices. And one of my problems was, stocks can be volatile. And sure enough, we all remember what happened when Google announced earnings in February. The stock went down 15% and he got executed. And he was upset about that. So a lot of times, like trying to time these individual stocks gets challenging. But I'd make the same comment combining what Phil you said and Kirk what you said. If you're gonna use them for the long term, you're gonna sacrifice a lot of return. You're gonna leave a lot of money on the table. But Kirk, to your point, if you're trying to use them as a market timing tool, like I think the market's gotten a little bit overblown, I still want some exposure, but I want protection on the downside. You have to sell something to buy that, and that's when people start, unless it's in an IRA, that's when people start getting hit with capital gains taxes and with the way we're up 46% since October of 2022. People have to start weighing some of these market timing tools with the taxes that they're going to have to pay to make those changes.
Yeah. I think that's great perspective. So Tim, I know you had a chart you wanted to share. I mean, I think, this kind of brings in, and this is one of the reasons I want to bring Bruce on, is to talk about this, because these ETFs have fascinated me. Because when they first created it, I'm always, and just for reference, I'm always skeptical about any new ETF. Not because I think it's a bad idea, but just because in my experience, when ETFs just come out, it's usually a train wreck. Like I had my experience of the inverse financials in 2008, which I invested in, like inverse financials, which means as the financials go down, I would make money. And even though the financials, it was basically the XLF, which is the financial, mainly large financials, but financial ETF, right? And then this one was the inverse, and I forget the label, but it was basically the inverse of that. So the financials went down something like, I don't know, like 40%. So I should have been up 40%, but yet I was down 5%. There's no possible way that should have happened, but it did, because it was a brand new ETF and the markets were a mess and whatever they were doing didn't work. And I was really, really mad. Fortunately, I didn't do it for clients, but I was just playing around with myself, and I was just mad. Like, why would that even happen? And I've seen that happen many, many, many times. So anytime there's something new comes out, I always let it season a little bit. Same thing with crypto, right? And I've shared this on a few of the Friday live episodes. With crypto, I have a thing on my screen which shows the more popular. I think there's 1, 2, 3, 4, 5, 6, 7, 8. There's 8 Bitcoin ETFs that I have on my screen. I know there's probably more, but I had 8. And I have them lined up against each other, and every day they're relatively close now, but I'm looking at one that I won't name them, but one's down 54 basis points and one is down 73 basis points. It's the same underlying. How does that even happen? Like, why is that so different when it's just
is one more expensive than the other? Well, it can't be expensive by 20 basis
no,
points.
No, it's the return is the return. It doesn't matter the price.
They're reporting an NAV return.
Well, it's an ETF. I don't know. My point is there's questions, right? And I don't have answers. So rather than just shoot in the dark and just hope I hit something, and I said this on the show, like there was like a full percentage or more difference on some of these returns in the first few weeks of the ETFs coming out. A full percent. That shouldn't happen. Like, I get it if there's like 4 or 5 basis points. I'm, like if you look at the ETFs, if you look at like the SPY and the Vanguard version, there might be like a difference in like 2 basis points in the percentage return. That's normal. I get that. But it shouldn't be 1%. And it was, right? So if they're actually marking it to market, which is what it should be, or people should be arbitraging the spread. Like there's a whole bunch of reasons it should align, but it's not. So it just leads me to believe, like, why is this happening? My point is when a new ETF comes out, it's never a good idea to jump in quick. And so like for us, like we were using the GBTC for Bitcoin well in advance of the ETFs coming out. Like we didn't change, even though it's cheaper, because if you look at it, even though it's more expensive, and it's a lot more expensive, I wasn't confident that the other ones would be priced accurately. So my idea, and we can get into, I know you had conversation about fees, Tim. But if you get into the theme of like, all right, what are we actually after? Like, do I care if for a few months my clients are paying a little bit more for the sanity of making sure it's accurate? Yeah, I'll happily do that. And once things settle down, which it looks like they're getting closer, but not there yet, then we can look at what is the best performer in percentage wise. Like, are they tracking? What are the fees? And there's like one or two that are pretty low fees. Like, okay, I'll consider those. But it's usually more than just fees, and most people just look at fees. And so when I look at something like these ETFs, when they came out, I was really intrigued, but I watched them like a full year just to see how they'd track. See, are they tracking what they should be tracking? And I set up a mirror portfolio of like a spread or whatever the ETF was tracking, and just watch it and say, how's it performing? Okay, it looks like it's in line now. Now I can kind of take a plunge and consider it. But I think this shouldn't happen, but it does, especially at the beginning. I think people just need to be aware of that. So
yeah, and you're bringing up a really fundamental issue about ETFs that I think people forget almost all the time. Unlike a mutual fund, an ETF has a market price and an NAV price. And if the ETF is like big, liquid, frequently traded ETF that owns big, liquid, frequently traded stocks, there's probably not going to be a very big premium or discount between the market price of the ETF and the NAV price of the ETF, because there won't be much dislocation between the price of the ETF and the underlying stocks. But to your point, when it comes to something like Bitcoin, I remember this has happened in the past with oil ETFs, gold ETFs, is sometimes you can get what's called a big disconnect between the price of the ETF and the value of the underlying security. So it may very well be that what you're looking at today, one ETF being down 54 basis points and the other one being down 73 basis points, one might be tracking Bitcoin very closely, and the other one, people might just be selling that ETF. Whether Bitcoin's getting sold or not, they might just be selling that ETF, and so its market price is behaving that way, regardless of the price of the underlying stock. So I would agree for almost everybody that's considering doing ETFs on their own, particularly some of the smaller, more nuanced niche ones, be very careful about how those things can disconnect, meaning the market price versus the underlying value, the NAV of the asset inside the ETF.
Yeah, that's good insight. Phil, I want to get your thoughts on this, because I know closed-end funds typically have a huge disconnect for many of them, where they can be like 50% difference in some cases, a discount even. There's huge discounts. Like actually GBTC at one point was like it was like a 30 or 40% discount off NAV. And people were, everyone thought, anyway, it can be a good opportunity, or it could be a sign of distress. So do you look at these things, Phil, when you're looking at ETFs or closed-end funds?
I will. And I think it was 2015, we had the flash crash. And I remember at that point, I was just working for an advisor, but my only responsibility was on the investing side. And like DVY, which is a big dividend paying ETF, if you looked at the value of the ETF that day and the value of the underlying stocks, there was a total disconnect because the market fell a lot that day. So people were selling the ETF because it was an easier way to do what they wanted than the individual stocks. I remember I had a Bloomberg terminal and I looked, and if you looked at the value, like I actually wrote an article about it, and and I had pictures of it, and you could see the big disconnect between the value of the ETF and the value of the underlying securities. So one thing that I think about is when the market gets really volatile, I do want to be a little bit more careful when I'm trading ETFs than I might be under normal market conditions, because I don't want to have that happen when I'm trading for client accounts. And I also want to look at the bid-ask spread. The other thing that I think that's also part of this, when you look at ETFs, the what's underneath doesn't always match what they say is in it. A great example of this comes when you're looking for like ESG strategies, environmental, social, and government strategies. Like I have a client that wanted to own, looking at the carbon aspects, right? The hydrocarbons, so looking at oil and gas, didn't want to own that. And if you look at the stocks, are supposed to be, the ETFs are supposed to be green, and then you look at their holdings, and they have like Exxon or Chevron or a refiner or something like that in it because they're theoretically the cleaner ones, but that doesn't fit the idea that if you're trying to be green, you're really not going to be owning these big oil and gas companies. So you really want to understand when you're buying some of these niche or ETFs, what they own. That's a big part of it too.
Yeah, and I think for reference, a lot of these green funds, the ESG funds, do own dirty energy, even though they say that's really not the intent, for many different reasons. In part because there's liquidity, there's market cap there. They they can justify it. It's like why ESG funds typically have a lot of tech. In large part, it's because tech generally fills all the boxes, and also it tends to do well, and it's liquid, and all these other reasons, right? And I remember way back there was we were looking at I think there was a clean energy ETF like over a decade ago. Yeah, I want to say it was like the early tens, and I was looking at it, and I was looking at geothermal stocks. There were only three at the time. I think it was like Ram Energy. I forget the second one, and then it was like Ormat or Orloff or something like that. It began with an O. Anyway, the last one, the third one, was the largest. And so you're looking at clean energy, and it was like, and it was filled with nothing that was clean. It was, you look at all these things. It's like, all right, which one is the best one? Right? Or what are the best clean energy stocks? And back then there really weren't a lot. Now there's more because it's a theme. But the energy companies, they were limited, and they didn't have rarely, if any, clean energy stocks. I think there were like 3 or 4, and the rest were just oil companies. It was weird. So you always have to figure out what you own. But I think it's really just important to figure out the disconnect between NAV and the market price, because I think most people forget that, and they just kind of buy and forget, and they don't bother thinking about it. And so anytime I hear, oh yeah, well this is trading at a huge discount, the first question is why? Like with GBTC, the huge discount is because people thought it would go under. Okay, great. It's either at a premium or discount. It's always done that, and it's just the nature of it. But with some of the other closed-end funds that are, a lot of them are bond related, muni related. There's like historically always a discount. I think PIMCO had probably the most closed-end funds trading at the biggest discounts, and I don't know why. I to this day I don't know why, but they're always up there. I'm sorry, my bad. I think they're trading at a premium. Come to think of it, and maybe I understand why. I don't know. But the point is you look at these things and you say, well, why would I overpay? When you see a discount, there's usually a reason. When there's a premium, there's usually a reason. The question is why? Like, what are you missing? Right? If it's a premium, you don't want to overpay. If it's a discount, you say, oh, well, great, it's a discount, I can make money. But there's no guarantee of that either, right? There's no guarantee you're gonna make up that discount by the time that you sell it. So it's just something to be aware of. Tim, I did want to share your thing that you shared, and we got to wrap it up here.
Okay.
You want to kind of walk through this really quickly because we were talking about market valuations, and I just wanted to.
Yeah, it wasn't anything that was meant to be like overcomplicated. Right? If you look at it, basically it looks at the number of stocks that are hitting their highest 52-week high in the last 3 years, and then it just looks at the number of stocks that are starting to participate in the rally. And so really the only point I was trying to make with that graph, and it was the point of the article, you can see from our weekly report there, it was the second article that we attached, was, and in fact, the prior week's graph was basically, you've got the biggest concentration in the S&P 500 of 10 stocks in history. It's at an all-time high. And a lot of people look at that and say, yeah, the S&P 500 is at a record high. It's going to fall. It's too high. It's overvalued, all of those things. And my argument was, well, but if you look at that concentration in those 10 stocks, right, maybe that means there are 490 stocks that aren't overvalued. And so the point was simply that, and I'm not saying that the market's going to go up, down, crash, peak, whatever. Excuse me, my point is, as I've always said, talking about how the S&P 500 is doing is a little bit like talking about how weather is on planet Earth. right? There's 500 stocks in there and they're all doing something different. And so to just look at the S&P 500 at an all-time high and say, it's too expensive, we got to get out, it's going to crash. It's important to look at the concentration of stocks, and these graphs side by side basically say that you're starting to see some expanding breadth, meaning it's not just the Magnificent Seven, that are just driving the market. Some of the other stocks are starting to participate.
Yeah, no, I appreciate that. It's very important to keep all of that in mind. Tim, you want to wrap it up here, and where can people find more about you?
Sure. Yeah. Again, thanks for having me. Our whole business model is based on helping people find complete financial services, including investment management for lower fees. So the whole idea is lower cost, better results. All of our information is available at metricfin.com, including our contact info and a lot of information about how we invest and help people plan for the future.
Great. Thanks, Tim. And Phil, final thoughts, and where can people find more about you?
Thanks for having me again today, Kirk. Appreciate the conversation. For me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our weekly blog. Thanks again for having me today, Kirk.
Right. Thanks for coming on, Phil. Appreciate you both coming on again. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.